Welcome to Pierpoint Perspectives, the securities finance podcast delivering commentary from the best, brightest and most innovative people in the world of securities lending, repo, collateral management and related areas. Pierpoint Perspectives is brought to you by the consulting team at Pierpoint Financial. So now, over to your hosts.
Hello and welcome to episode 12 of Pierpoint Perspectives. I'm your host, Roy Zimmerhansl, and practice lead at Pierpoint. We're going to talk about what borrowers want from lenders. Now, regular listeners will recall that we covered this topic in one of our earliest podcasts, but today we're going to expand on those topics a little bit further and add some new ideas as well. I'm joined by my colleague Jeroen Bakker, who runs our Benelux Consulting practice. Jeroen has been both a lender and a borrower in his career. And those of you who read our blogs will know that he's written a series of blogs focused on the trading side of the borrowing business. So why do people borrow? And now he's in the midst of a series of blogs covering some of the famous or perhaps infamous transactions involving securities lending. The first in his series was on Wirecard, and the most recent looked at the short squeeze, which temporarily moved Volkswagen into the position of being the largest company in the world as measured by market capitalization. So, Jeroen, hello, and thanks for joining me.
Thanks, Roy. Thanks for having me. Yes, I think that our previous podcast was quite good, but there were quite a few topics that I want to drill in further. So, thanks for giving me that opportunity.
Right. So, we're going to talk today about really three themes. One is what borrowers want is flexibility from lenders, and we'll define what we mean by flexibility. Number two, clearly the most important thing always is supply, but there's more to it than that. And the third part is reduced costs and how that has an impact. And so some of this for listeners to the original podcast, some of this will be a little bit of repetition, but in where we're repeating things, you'll be going into more depth by what we mean and the kind of issues that you think are important to borrowers. And for the remainder of the items, they are new discussion topics that we'll be going into for the first time. Right? So yes. Let's just get started. Why don't we start with flexibility? Where do you want to take us with flexibility, and why is that important?
I would say that flexibility that lenders can provide to borrowers is key. There are multiple topics on flexibility, but let me start off with the ease of trading. Securities lending by itself is not complicated. As we always say, it is not rocket science. It's not rocket science. So let's not make it rocket science and get it easy and done with. It is easier to put a trade on the book than it is to get back and forth and try to get to a consensus of setting up the trade. So when I'm talking about ease of trading, automation comes into play. The preferred route is the easiest route. So whether or not that is NGT via Equivalent or any other types of electronic trading platforms, file transfers, anything that avoids the securities lending trader, both as the lending side as well as on the borrowing side, to have to send out Bloombergs, maybe pick up the phone, agree a fee, agree a collateral, and then by the end of everything, book a trade manually in the system. If that process takes 5 to 10 minutes, that means you might do 10 trades an hour, which in the current volumes that both borrowers and lenders act on is not possible. So what makes sense? File transfers, good big baskets of shorts covered all in one go, in one email or in one file transfer, in one upload to an electronic trading platform, and then have it automatically load back into your system and trade done. And that means that both the trader on the lending desk as well as on the borrowing desk can then start doing what they should be doing, and that is add value to their own book. So I would say get everything which is easy to do, out of the way, and then start focusing on the hard stuff.
So I guess that's for a number of different reasons. So what you're talking about, number one, is just sheer volume of transactions. Number two, the manual involvement is not only time consuming and reduces your output, but I guess it's also error prone, wouldn't you say?
Manual intervention is almost equal to errors. So as soon as people start using file transfers or using electronic trading platforms, the error rate has to come down, will come down. And one of the key things, of course, is that an error made on the front office side has a ripple through effect through the entire chain of the trade. So I don't know, if the trade gets booked wrong, that means that the matching of the collateral goes wrong. That means that the fee and the accrual of the billing goes wrong. On and on and on. Potential corporate actions will go wrong, and those are different groups within each entity that will have to sort out those issues. So yes, if the traders on the front end can make sure that they don't make mistakes, it will have an almost incremental effect on time saving within the mid office or in the back office on both sides of the trade.
And I guess that's particularly important today in an SFTR environment where problems aren't just issues that need to get resolved by settlement date, but in fact, it becomes a regulatory reporting obligation and problems not just for you, but your counterparty in terms of compliance.
Indeed, and as you said, SFTR is important. CSDR has been delayed, but let's go back to SFTR. Currently, there are, of course, no penalties involved, but yeah, that will change. So not only will you have a saving of the amount of time that people spend on your transaction, but potentially also that you have a saving on penalties that you have to pay.
Right. So I'm going to give you a little bit of a pushback here, though, because in my last role, we spent a lot of time implementing really strong, powerful, efficient front-end trading capability in our software. The biggest issue we had was getting borrowers to code their accounts properly, right? They were all busy with, at the time, worrying about UMR, and it was the very early days of planning for SFTR. And in order to get truly automated trading, you need to have accounts coded correctly. And frankly, it was a challenge for a handful of the borrowers. So do you see that? And I assume it goes the other way as well, but some borrowers want to improve the trading automation with lenders, and it's not always top of the list for all of the lenders. So what are your thoughts in terms of the focus, attention, and recognition of the value of automation?
Well, let's start with the last one, the recognition. Everybody knows that it's important, and you're right. So a lot of the borrowers are screaming for supply and saying, okay, I want to trade with all your accounts. And then lenders will turn around and say, okay, fine, here are my accounts, set them up. And then all of a sudden things go quiet a little bit, mainly because it is quite a cumbersome task to go through all the checks and balances required to open up new clients. Quite often, not quite often, it is not a task that is done by the front office and the trader that wants to get those funds over the line. So he will outsource it to a credit or to a risk team. They are often also much to the limit of capability what they can absorb in work. So it will go into a queue, and for some reasons things will always jump a queue. There's always a fire that needs to be put out, and but you said as well, like, okay, fine, it is a complicated procedure to get it right, but you need to get it right in order for your risk and your credit calculations to be done correctly. So yes and no. Yes, the borrower wants to have as much inventory as possible and as much funds signed up. And some of the lenders will lend on a disclosed basis, so they will tell upfront who the actual client is, and that already makes it a lot easier for a borrower to either pick or choose, or to increase the priority of a certain onboarding. Some other lenders use, I would say, antiquated systems to work on a undisclosed basis, and they will not know who they trade with, and they will not know where their ultimate risk lies at the moment of transaction. So if a certain lender says, well, can you onboard all my clients, or can you onboard these 50 or these 100, the borrower will not exactly know if and when it's done, if that actually comes to fruition in additional flow. So long story short, undisclosed versus disclosed, it is a topic that's been on the agenda for a long time. Hopefully with SFTR, things will become less of an issue, but still it is there.
Yeah, look, thanks for that. I think that's right. I agree with everything you said there. The reality is the whole beneficial owner approval process on both ends, both directions, I think, is something that is ripe for change at some point. And again, I think it will hold back the industry in terms of accessing new supply and bringing new participants to market if there's not a resolution for that. But I want to ask you a question about the breadth of electronic trading, because most people, when they think of automated trading, they look at general collateral or the high volume, low margin transactions as being natural for automation. I don't think anyone would disagree with that. But in terms of stocks that are in demand, what we would call maybe warm or sort of medium stocks, and hot stocks or specials, I guess there's different schools of thought in terms of whether those should be automated or whether those should be handled manually. So I'm curious as to what your thinking is.
Yeah, so let's go back to something I said earlier, is that when traders, both on the lending side and on the borrowing side, can have their general collateral, their easy transactions out of the way in a very quickly manner. So even before they come in, so fully automated, they come in and at least those transactions are already sorted. They don't have to look at those ones. Then they will then have time to go after the medium hot or even the very hot, the special stocks. And yes and no. One is indeed, if there are systems out there that you can have a kind of bid offer spread where you can say, okay, fine, in these particular brackets, I am willing to take these stocks, and the lender will upload those files. Okay, these are specials. Minimum, I want this, or this, and then you can have a negotiation on screen and come to a conclusion, which, of course, from an audit perspective is great, because then there's an audit trail. The booking of the transaction will get automated on the back of the conversation that's been dealt with as soon as there's a conclusion and people come to an agreement. So those are the more sophisticated flows. However, yeah, there is still a lot of people out there that will not show their specials or will not want to trade their specials through certain platforms, just because saying, well, I need someone either behind the Bloomberg or behind the telephone to really have a good eye on what's going on. So I don't want something going out and then the next day I find out that I am 20% or 25% under the market. I want people to be on the ball and get the right fee. My thought in that is that that's not really what it should be like. If you are 25% on the market, you can always get a rebate. So my school of thought is get the trade out there, get it done. It's easier to rebate than put the trade on the book.
Right. So for listeners out there, we didn't plan that exchange, but That's exactly what I think. It's always harder to get a trade than keep a trade. So my view is trade everything electronically, make it easy, as you say, to capture that trade. You can always re-rate, and if something's special, it's not going to be just special for one day. So you have a whole lifetime of the transaction to get it to the right price. So look, I think we could probably do an episode just on trading. I want to move on now. Let's look at another really big element of flexibility, and one that probably gets spoken about even more than the issue of ease of trading, and that's collateral. Yeah. Talk to me about collateral.
So collateral, well, back in the day, used to be quite rigid, right? It was US dollar cash. That was what securities lending was traded against. But predominantly the European entities, of course, did not have a natural in US dollar cash. So they were trying to find other ways that they could collateralize transactions. And of course, that came into play with non-cash collateral. And then if you're talking non-cash collateral, there's a wide variety of assets that are available and can be pledged as collateral. So let's start with the biggest one, I would say, which is government bond collateral, G3, G7, whatever you want to call it. Let's say the main European countries and of course the US countries, the US treasuries, as collateral, widely accepted across the board, but also quite expensive to get hold of. Then as you would walk down...
Sorry, Jeroen, so why are they expensive? Explain to me why they're expensive, because surely it's just another asset that a bank has.
Well, that's the question, right? Does the bank have that asset? If the bank does have that asset, then you have to calculate how much the bank would generate in income if he would not pledge it as collateral, but start using it as a commodity and start trading it away, either in a repo or potentially on stock loan themselves. So therefore, the asset itself on the book could be a revenue generator. If you then start pledging those bonds somewhere else, they don't make any money. So they are, they're a loss maker. So from that perspective, you can say government bonds are expensive because they can be used elsewhere, and therefore there's an opportunity loss.
Yeah, so I think that's the issue. It's the opportunity cost. So if a bank, as you say, has government bond positions, then the reality is, first of all, they have to use those where they're required to use them. So first of all, banks often have or typically would have a regulatory requirement to maintain a certain amount of government bonds on their books. So even if there are things that they could do with those assets, they really need to keep them. Then there's situations like central counterparties where the collateral is often primarily government bonds, so they don't have a choice about that. They have to put it there. And then you get into, as you say, other opportunities. Can they lend them out? Can they repo it out to get financing in for the bank? So it's really about a number of calls on that asset. And the more flexibility that you have in terms of applying that asset, the more value it has. So government bonds are pretty widely used, and therefore there's lots of different options, which makes them expensive from an opportunity cost point of view. So that's government bonds. Where do you want to go next?
I would say next is the equities, and then we're taking equities in let's say all the indices in all the countries itself. So of course there is a big discrepancies between what certain lenders will accept as equities and in what kind of tenures and what kind of concentration limits and what kind of average trading volume. So all these kinds of parameters are important, but equities by itself are, in the same school of thought that you had on the government bonds, are cheaper to use because, first of all, they are not used everywhere else, as you said, at CCPs or certain requirements that they have to be kept on the balance sheet. And they're also more widely available as a bank because the bank will always have those assets from different angles. So they could have a cash equity book where they are long equities. They could have a cash derivative book where they have positions on the books themselves. Of course, their hedge fund clients can pledge their long inventory, which most likely is equity, as collateral with the prime broker. So all these pockets of inventory, equity inventory, is widely available and therefore can be used. The problem, I would say, would go into when equities become more exotic. So if we're talking not the main tier indices, but the lower or the really small cap indices. If we're talking outside the main countries, or we're talking emerging markets, those equities are potentially on the book from the borrower, on the book of the borrower, and is looking to monetize those, and he's trying to look and place those equities as collateral. If a lender can accept a lower rated or a lower index or a lower country as collateral, that will mean that they all of a sudden becomes quite popular or quite in favor of the borrower, because not everybody can accept those collateral. So you want to divert your transactions, your borrows, to the lenders that can accept the collateral that you have the most problems getting rid of your book of.
Yeah, and I guess equities have their own issues because, as you say, an investment bank might end up with equity positions from a number of different reasons. And so it's almost like a byproduct of whatever those other activities are of the bank that creates the portfolio that's available. And that's why you have issues potentially with concentration, because they may be trading a particular name in large size, and therefore their collateral position will be very large rather than more diversified. So you come into those sorts of issues. The other thing that we saw this spring in March and April is you have kind of a catastrophic market sell-off, which I guess does two things. Number one, banks are closing out any long positions where they have the ability to do so, and where it's their client inventory, the clients may be closing out long positions. But also from a lender point of view, there's risk with equities. I mean, equities clearly are more volatile than government bonds. So shouldn't that be a concern?
Yes, you're right. Equities are more volatile than government bonds. Whether or not the liquidity in equities is higher or lower than government bonds, that is something that is very depending on which countries and which government bonds and which equities and which indices you're talking about. But yes, so if you are accepting equities as collateral, make sure you have your parameters around it set correctly. So your risk appetite is very depending on what kind of margins you want on your equity collateral, or what kind of average trading volume you want to have on your collateral. And let me dig a little bit deeper in that, because if we're talking average trading volumes, we're talking about how much of the particular stock is traded in the market. So in case of a default of your borrower, and you have the equity collateral of that borrower in your position, of course, you need to sell those equities in order to buy back the positions that you've lent to the borrower. If then you have a position that is potentially trading 100,000 shares a day, but you have 1 million shares, that means it takes you 10 days to sell those securities. Of course, 10 days in a normal market environment might not be an issue. 10 days in a very volatile market environment could be a very big issue. And in 10 days, that stock could halve or could maybe even have less 20% of that particular stock in value. So at that particular case, you're running a risk, and of course you're running at a loss.
Yeah, there's a couple of things on that. First of all, if you have 1 million shares and it trades 100,000 a day, it's not really 10 days, because that's 10 days at 100% volume. So actually it's longer than that.
Yeah, correct, yes.
So that's on the one side of it. I guess the other thing, though, that I always try to remind people that are considering this kind of collateral switch or adding this onto their program, is that, of course, in March and April, there's no question that if you were holding equity collateral, the value of those equities dropped. But of course, two things. Number one, the daily mark to market means that you're getting more collateral in every day where it's needed to cover that shortfall. So it's not like you're going a week or 2 weeks of volatile times before you're getting topped up. Number one. And number two, the important thing to remember is that, of course, if you've lent out equities against equity collateral, the equities you've lent out are also crashing. You know, in my history of working with credit departments, they seem to think that in a market crash, all of the equity collateral we take falls, and all of the equities we've loaned out miraculously have had a bull market against the trend of the rest of the crash. So in terms of correlation, I think equities, to me, are a very powerful form of collateral. And then the third part is liquidity. Well, look, you don't have a market crash in quiet volume. So in fact, liquidity of equities often goes up in falling or chaotic markets, therefore making it even easier in terms of volumes to dispose of assets, you know, if we decide any potential price movement. So I think it's a really complex series of factors, Jeroen, wouldn't you say?
It is, and that's what I also meant is with get your parameters right. And taking a bit of a sidestep, one of the things that could help a lending getting those parameters right, or at least monitoring those parameters correctly, is potentially go to a Triparty collateral provider, which then will price your collateral, will make sure that the collateral is according to preset parameters that you, and maybe in combination with your collateral manager, set, and thereby you are then of course you still have to monitor what they're doing, but you do not have to make sure that your parameters are constantly met. Some third party will do that for you. And of course, one advantage of a third party collateral manager is that the cost, the bill, has been packed up by the borrower, so the lender will not have any costs for their collateral anymore.
Well, there's no such thing as a free lunch, so I'm sure the cost of collateral is calculated in there somewhere. But look, I have to say, I don't see how anyone can manage an equity collateral inventory without the use of a Triparty. This is not a Triparty advert, but it isn't like the old days where we used to keep lists of who would take what and try to guess what capacity anyone had for any particular form of collateral. I mean, it's gone way, way beyond that today.
And on top as well, of course, if you're not trading with one borrower, you're trading with a full suite of borrowers, and you have to make sure that you have your oversight. So not that if one borrower pledges a particular stock, it's fine. But if 10 borrowers all pledge the same stock, you might end up in your concentration limit. So that's why it's important that you have that parameter set right. And yeah, as you said, it's not advertising, but the Triparty collateral providers have some experience in that.
Great. So you'd mentioned to me ETFs as collateral as well. So people know I have very strong views about ETFs. Why don't you let me know what your thinking is on it?
So exchange traded funds, again, it is something that is important to certain borrowers, not all borrowers. If you are a market maker in ETFs as an investment bank or as a borrower, you have those assets on your book. Technically speaking, they are equities. So can they be accepted by everybody as equity collateral? No, because people say, well, yeah, we're not sure what's underneath the ETF. We're not sure what we'll have in case of a default, what we have in our position. We don't want to receive an ETF from a borrower that's also the market maker, or it's also the exchange agent, or it's also the issuing party in the ETF. So there are different topics to discuss when you're taking ETFs. I'm just saying at the moment, for certain borrowers, it is important to be able to pledge ETFs as collateral because, again, they have them on their balance sheet and they want to utilize those assets. So if you are that lender that is comfortable with taking this asset type as collateral, you have a benefit compared to your competitors that don't accept those.
And that's really what you're talking about with all of these things. There's nothing that we'll be talking about today in the program that is black or white. There is no yes, if you do this, you'll be super successful. No, if you don't do that, you'll never get any revenue. And it's really a blend of things, isn't it?
It's not one rule fits all. So all borrowers are different because they all have different business models. They all have different clients. They all have different trading strategies. And of course, not all lenders are the same because they all have also their own regulatory requirements that they have to adhere to. Some cannot accept equities as collateral because they're not allowed to by their regulatory body. But yeah, as I said, like not everything that we talk about today fits everyone.
Right. So let's look at the last element that we're going to talk about in flexibility, and that is term transactions. What do you mean by term transactions, and why are they important, and what does that do for the borrower and ultimately then the lender?
So with term transactions, we mean terming up a particular transaction for a certain amount of time. So that could be the lender guaranteeing that stock will stay out there for a week, a month, 2 months, 3 months, 6 months, a year. And that has advantages for borrowers. There are two different kind of term transactions, and let me start with the easier one to explain, and that is related to certain corporate events. If there is a rights issue, if there is an M&A, if there is a convertible arbitrage out there, the time frame in which this will happen is quite often is available, can be readily seen. But for the borrower and for the client of the borrower, that could be the internal trading desk or that could be the external hedge fund client, it is important that they will know that they have that borrow on the book until the end of the certain event that's going on, until the deadline, until the conversion of the either the M&A or the rights issue, or whatever is going on, because that way they know that the trading strategy will be successful. Because if they get recalled prior to that term date of the event, that means that they either have to close out their positions and will not be able to get to benefit from the premium that particular event has, or have to borrow somewhere else at a higher or cheaper level. So that is what I would say term transactions in corporate events has a benefit for borrowers in order for them to make sure that they make the arbitrage that's on the book. For the lender, in return, that has a benefit because the borrower will be able to pay a higher fee, a bigger return to the lender in exchange for that guarantee. So, in short, there's a corporate event going on. The borrower wants to trade that play, wants to benefit from the premium that's on the table. But in order to do that, he needs to borrow stock, and he needs to borrow the stock to make sure that it hits the date that the actual conversion of the event takes place. In return, yes. Sorry.
I thought you were finished. I mean, I think that's a perfect example of what I often talk about, where securities lending is often about trading flexibility for fees. So really what you're talking about here is a lender that can commit to a term is giving up the flexibility to cancel that trade early and sell it and recall it. But in return for giving up that flexibility, they're getting a premium, as you suggested.
Yes, indeed. That is one end. One other, I would say, big example, and maybe even bigger than the first example that I provided, is in the financing space. So banks need to comply with certain regulatory ratios. The liquidity coverage ratio, which calculates how liquid a particular bank is in case of a big market event, let's say a big crash. In order to comply with those regulations, a borrower needs to have high quality liquid assets on their book, HQLAs. HQLAs is cash by definition, but also government bonds. So US Treasury, UK gilts, the European govies, those are all HQLAs. If you are a prime broker and your main area of expertise is equity trading, you have a lot of equities on your book. Equities are considered non-liquid under this regulation, so that doesn't matter how many you can trade in the market, but it is considered non-liquid from an LCR perspective. That means that the borrower wants to go out and find a lender that can lend government bonds versus the equity collateral that they have on the book. That by itself, you can consider a collateral upgrade trade. So they're getting a higher asset or high quality assets in return for lower quality assets. So that's already where they are willing to pay a fee for. However, from an LCR perspective, they need to adhere to some other hurdles. And one of those hurdles is that they need to make sure that they can have those assets on the book for at least 35 days. So in order for them to guarantee that they have those assets on the book for 35 days, they want to borrow those government bonds for 1 month, 3 months, 6 months, 1 year term. So they're borrowing an asset class, let's say gilts or German bonds, versus equity collateral on a term basis for 3, 6, 12 months. Quite often, they also provide a right of substitution. So that means that the lender itself guarantees a certain value of bonds that they lend to the borrower, and not so much a certain set of ISINs. So for instance, if their client sells one particular German bond, they can replace that with another particular German bond in order for them to maintain the entire size of the transactions that they agreed up originally. And in return, again, the borrower is then willing to pay additional fees. So first of all, he's willing to pay a fee for borrowing the government bonds versus the equity collateral. And then when you're terming up the transaction, so you're guaranteeing the transaction for a certain amount of time, the borrower is willing to pay additional premiums on top of that.
Right. And so the use of the second example, so the first example that you gave about terming up inventory for corporate events, typically that's tied to a trading related idea for probably an end client of the borrower, like a hedge fund. And the second one is much more about the bank managing its own positions, exposures, ratios, and requirements, right?
Yeah, so the first one is more a trading strategy related borrower. The second one, I would say, is more what you call a financing or a collateral treasury related transaction.
Right. So look, I've realized that we spent a lot of time on the flexibility on the collateral side of things. I'm interested in listeners. I could have gone into many more questions for Jeroen on this one. Question for listeners, drop us a line. Let us know if you want us to do an episode specifically talking about collateral in more depth. I'm interested in hearing about that. So I want to switch now to supply, because at the end of the day, what borrowers really want is the most in-demand securities with a guarantee of no recall, uncollateralized, and for free. Now, assuming that generally they can't get that, I assume that there is a fallback position. So what would you say is the single biggest issue with respect to supply?
Well, I wouldn't call it issues, but I would think that there are two things that are always on the mind of a borrower. That's depth and that's breadth. So what do we mean by those? With depth, we mean the actual size of the inventory that the lender has. So if the borrower will go to the lender and says, I want to borrow stock XYZ and I want to borrow this amount. The lender says, yeah, sure, no problem, here it is. Great. That means that the borrower has done that trade in one particular go. Everything is booked, everything is done for. If the lender says, well, yeah, but I can only do 20% of that, that means that the borrower has to go out again to another lender. And the guy says, well, only we can 10%. So that means that he all of a sudden has to start building up his book with more lenders and thereby doing more transactions, getting more costs, costing more time. So if we're saying depth, it means that you go to one particular guy, he has everything you want, and it's done, it's dealt with. If we're talking breadth of supply, we're talking about the number of securities that the lender has available for loans. So that means that if he comes with a basket of 100 securities and one particular lender can fill all 100, great, done, over, done, next topic. Again, if he has to say, okay, fine, here's a list of 100, and the lender says, well, I can fill 20. That means he has to go to another lender and fill the 80, and et cetera, et cetera, et cetera. Again, costing more time, costing more work, and also more transaction costs. So, two things are always important, always in the back of the mind of the borrower. It's the depth, and it's the breadth of supply that the lender has, and thereby also generating more like a preferred lender list. So the borrower will always think, okay, fine, these group of lenders, if I can go there, I will get my transactions done. So yeah, ease of trading, he will go to those lenders and get those transactions done.
And so it's almost a self-fulfilling prophecy that big lenders attract more business.
Yes. And
so how does a medium or smaller size lender compete with that? Because if you're not big, it's if you can get big, then it still takes time. So what do they do?
Well,
because presumably you didn't just borrow from the biggest lenders in your past.
No, and so there are, I would say that there are other things that are come into effect as well. So yes, you're right. If the traders that I work with would only go to the big guys and get everything filled there and it's over and done with, yeah, easy. But quite often there are particular stocks out there that are either difficult to get hold of, or difficult to get hold of in the size that you want. So yeah, if the big guys don't have it, then you have to go to the smaller and maybe more regional players that are out there. If you're looking for a particular hot German name, yeah, it's easier to go to a German lender, because quite often the German lenders will have the German clients, and the German clients would have invested in that particular German stock. But you can't go to a lender and say, well, yeah, I know I haven't talked to you for a year, but I need this stock. Yeah, I know it's special, and I'm willing to pay X, Y, Z for it. The lender will go, well, hang on, there is more to it than just coming to me and getting this stock. Let's build and have a relationship. So let's do other kinds of transactions instead of just the hot stocks and the specials. Maybe some GC tickets. Maybe that lender has one particular issue where he wants to get certain securities lent as well. Okay, fine, a borrower can participate in that. So it's a bit of giving and taking.
Yeah, and so I think that's right. Look, I don't expect anyone to make a decision again binary that is I'll only deal with big ones, I'll only deal with small ones. One of the interesting points I think you made there, Jeroen, if I can interrupt, is that investors in domestic countries are always the most diverse investors. They're always the most stable investors, and that's an advantage. So when you're constructing your portfolio of lending relationships, for key markets, I think it's always important for a borrower to be thinking about, yes, I need lenders that are in several domestic markets, because although I might prefer the collateral terms or the pricing or the size of the relationships from global participants, I do sometimes need to be able to rely on that local depth and breadth, which really can only come from a domestic investor. And to me, that's one of the reasons why a country like Spain is always an issue, because Spanish investors, domestic investors, can't participate in equity securities lending.
Yeah, so you're right. So, but it is a bit of a chicken and egg thing, right? So the supply that the borrowers have, the demand that the borrowers have is, of course, not out of nowhere. They have either their internal desks, the cash equity, maybe their emerging market making desk, they have a derivative desk, and of course they have their hedge fund clients. If they have a hedge fund client that is heavily investing in one particular country, i.e. shorting in one particular country, and that is a niche market, you need to find the supply that fits the demand that your clients or your internal desks have. So you're right. If indeed a German local player, they often have more depth and more breadth in German securities than the big global players. So as a result, if you have a hedge fund client that is heavily shorting in particular securities in Germany, you need to make sure that you have the relationship with the long inventory holders in those particular countries.
Yeah, and I just want to turn to a different aspect of it, and that is that investors that lend their portfolios often have similar investment mandates, in the sense that they track the performance against the same kind of benchmark indices. So this became really relevant to me when I moved to Hong Kong, and I spent more time looking at Asian securities, and the realization that borrowers were always looking at investors who typically were following MSCI as their benchmark, and really were always asking me to go find lenders that track the FTSE or other indices as well, just because of the composition that was likely to be in that portfolio. Have you come across that particular need or issue or demand?
Well, I'll give you a true example, and that is the Turkish main index. At the moment, of course, there's lots of things going on in Turkey, and I'm talking it was a bit more stable than it is now. But the main index in Turkey consists of 30 names. The MSCI tracking in Turkey consists of 27 names. The 3 missing names were the hardest to get hold of, and also, of course, therefore the most expensive ones to borrow. And the only way you can get hold of those is if you could find a local player in Turkey that was indeed not tracking the MSCI, but was tracking the index, and thereby be able to lend those 3 missing securities. And of course, those were the missing securities that you need, because your client was also doing the index play on the other side. So yeah, you're right. It is always a matter of what's out there, and if indeed a lot of the investment firms that you're dealing with are tracking the MSCI, then it's the question, okay, fine, how do I get hold of the securities that are not in the MSCI?
Yeah, so I guess the message that you are trying to give there to investors that aren't lending, if you track MSCI, of course, people are still interested in your portfolios, depending on which markets you are invested in. But they're particularly interested in your assets if you have a different benchmark to MSCI, right?
Yes. Or yeah, no, you're right.
And the same for agent lenders, salespeople. Get out there and get the non-MSCI lenders into your programs, and it will pay benefits. Jeroen, I want to touch on two more things before we conclude the episode, because we spent a lot of really good time digging into, I think, important, meaningful issues. So we won't be able to cover off everything that we had planned to. But I want to look at two remaining issues about the supply side here. One is exclusives and the other is synthetics. Now, we're going to be doing another episode on exclusives. So maybe if you could just give us a minute or two in terms of where exclusives fit into the program, and maybe that's a little bit of a teaser for what we might talk about in our next episode.
So let me start explaining what we mean by exclusives. Exclusives are particular transactions or setups of transactions whereby the lender will guarantee inventory to the borrower. And what I mean by guarantee is I can find it will fence off a particular part of their total inventory and will say, okay, fine, XYZ of baskets or XYZ of securities are solely for this particular borrower, and the borrower in return will pay the lender a fee. And that fee is not depending on how much the borrower actually will draw down out of that portfolio. So it could well mean that the borrower says, okay, fine, I want to have 500 million of Vodafone and of HPC shares. Can you block those for me? And I'm willing to pay X amount of basis points for that. If then the borrower doesn't take down any of those stock, it's fine. The borrower will still pay a fee to the lender. In return, of course, the lender cannot lend those particular securities that he has ring-fenced for that particular borrower to anyone else in the market. So that's what exclusives are considered to be. And why were they put in place? Quickly, I think when the hedge fund boom in the mid-90s took off, a lot of the PBs wanted to make sure that they have guaranteed supply for their hedge fund clients in order for them to show the importance to the hedge fund, because of course hedge funds can take business across multiple PBs, and of course PBs are fighting for the business for the hedge fund. So the PBs were going into the agent lenders and into the beneficial owner community and trying to lock in inventory for their own supply. I would say quite often it's done via an auction. So the lender will send out the baskets to the markets and say, okay, fine, how much are you willing to bid for these portfolios on an exclusive basis? And thereby, the lender also has a bit of price discrepancy. What he knows how much a portfolio is valued. If multiple parties are bidding on one particular basket of securities, the lender has price discrepancy, so he knows exactly what the value of those securities are. I would say quite often it's for 1 year. That's quite a common tenure for exclusives, and often as well it's more into the emerging markets or more the small and mid cap section of securities in order for borrowers to capture and guarantee inventory that they are generally getting more difficult to get hold of.
Right. So just a couple of things. So when you talk about people putting out their portfolios and getting bids in, rather than discrepancy, I might call it a variety of bids so that they can see what the range of intrinsic value perception is amongst the potential borrowers, right? Is that what you were suggesting?
Yeah. So you can call it price discrepancy, or maybe just Yeah.
And I guess the other thing, when you talk about it being in smaller cap stocks or mid cap stocks or emerging markets, from the borrower's point of view, they're trying to capture that scarcity value and keep it exclusively for themselves, right?
Yeah, lock it in, make sure that nobody else has it, and in return pay a premium for that.
So, Jeroen, that pretty much covers off exclusives. And as we've said, we'll be doing a separate show on that. So I think that covers it off well. The other point you mentioned was synthetics. So maybe can you explain to me what synthetics are and what their place is in terms of the trading universe?
So on the synthetics, we consider derivative structures. And the reason for those derivative structures is that it is providing short coverage in a different way than in the regular securities lending market. So in the securities lending market, you actually have a physical delivery of securities. In the synthetic market, those are all, as I say, on a synthetic basis.
So what do you mean by synthetics?
So you can consider different products in synthetics. Mainly, the main known ones are the swap transactions. We're talking performance notes. We're talking low exercise price options. All structures where you are providing the short coverage for the hedge funds or for the investors in a way that is different than the plain vanilla lending structures that we know.
So in a typical transaction, a would-be short seller goes to their prime broker and says, look, I want to get short exposure to this stock or this market or this basket. I don't want to do it in the cash market, or what are my options? And the prime broker will say, well, here's the different structures we can do. We can either do it in the cash market or we can do synthetics. But why would a prime broker be interested in offering that on a synthetic basis rather than the cash market?
Multiple reasons for that, Roy. The main one is regulatory. So synthetic transactions are seen different than the plain vanilla transactions that we talked about earlier. So from a balance sheet perspective, it is less punitive to have a derivative transaction on your book than it is to have a cash settled SBL transaction. One of the advantages as well is that you can cover your longs and shorts, so you can net off all your derivative transactions in one go, and then the ultimate what's left below the line is something you then start covering in the cash market. So it's a cleaner way to transact for a lot of parties.
Yeah, I mean, one of the challenges here is that there's actually regulatory disequilibrium here. Regulators, you can, from an investment bank point of view, the exposure that they have to the customer and into the marketplace would effectively economically be the same, but there's a better capital treatment for synthetics is what I think I hear you saying.
That's correct. Yes, indeed, you're right, Roy.
And what about, I guess the longest application of synthetics has really been for markets where it's difficult or impossible to do securities lending. Is that still the case today?
That is indeed still the case. So markets like emerging markets are quite often first entered on a synthetic structure. So a swap transaction might be possible, while a physically settled securities lending transaction might not be possible. So in order to find the exposure that people are looking for, the synthetic route is quite often in emerging market the only way to achieve that. That being said, what you talked about earlier in relation to capital requirements, a lot of the prime brokers, of course, also use these transactions in the main markets that everybody knows, just because from a regulatory capital requirement, it makes more sense for them than to do them on the physically delivered settlement.
Yeah, and I think it's hard to really know what the size of this market is, but there have been public reports from a number of the PBs that for one of them, in fact, earlier this year was talking about them making as much as half of their PB revenue through synthetic transactions. Doesn't mean it was half of their volume, but it was half of their net profitability. So that's pretty huge, isn't it?
It is huge, and as you said earlier, it's for a beneficial owner or for an agent lender, it might be a bit more difficult to enter those markets. However, we've been approached by quite a few people in the market that say, okay, fine, how can I achieve additional revenue? What can I do else what I'm not doing at the moment? And then, quite often the discussion steers towards the entire synthetic / derivative angle. So you're right. So a lot of the PBs are active in that, but it's predominantly a PB market, and you see a few of the beneficial owner, few of the lenders participate in synthetics in derivative transactions, but it's not as common as it is with PBs, of course.
Right. So I look at two interesting trends. So we have both worked at a place that was quite active in a country like Saudi Arabia, for instance, and that's a classic example of a market where it hasn't historically been possible to do physical cash stock loan or short selling, but short exposure has still been acceptable from a regulatory point of view via swap. So that would be one example of a market that now could emerge from being a swap only market into one that has swaps and cash equity trading as well for short selling.
True. Yes.
Yeah. Now, I guess just as sort of a closeout point of view, because I think probably synthetics are a big enough and profitable enough and complex enough issue that we might have a podcast on that alone as well. But I guess your recommendation to beneficial owners is, if you're already in the derivatives markets, so if you already structurally are able to trade derivatives, including swaps, if you can already do that, this might be one way for you to capture additional revenue that you can't access via securities lending, or where you'll have a competitive advantage to a cash loan. And, we'd be happy to talk to people about that. Would that be what you would sort of recommend to portfolio managers?
Yes, I would. One of the things as well is that you need to take into consideration that quite often a securities lending desk, whether or not it's an agent lender or it's a beneficial owner or it is at some other entity, is a bit at arm's length with the portfolio manager. And if you want to be successful in transaction synthetics to generate additional alpha, it is key that you have those lines as short as possible, because there are definitely a lot of ramifications when you're entering into these markets. And one of them, and that's quite an important one, is that the portfolio manager cannot sell the security if it's out on swap. While of course, if it's out on loan via the cash settled securities lending, then just a normal recall would be occurring. And that's with synthetic trades is different. So I think communication is key.
So I think that's a great point, which is really, I think, important to make, because it goes back to one of the principles that I see about securities lending, because it is so flexible, because either side can close out the transactions when they see fit. That kind of flexibility comes at a price. And that price is uncertainty, and uncertainty leads to lower costs. If I'm a taker, I'm less willing to pay for something that's not secure. As a lender, if I want to retain the flexibility of it, I can't really demand a higher cost. Whereas on the synthetic side, as you say, that's a commitment. That's a straight out commitment. But I do have a funny story. So in probably 15 years ago, when I was at an equity finance unit of a major prime broker, we had one of our equity derivative salespeople come rushing over saying, "Great news! I've been speaking to fund manager ABC, and I managed to get this basket of securities on swap. So it's fantastic news. I've just traded it with them. That's ours now. So good news. We can structure our trades using this supply." And we went, "That's fantastic." Went back to our desks, got a huge recall from a major agent lender, And in fact, what had happened is the sales guy had sold it to someone who we were already borrowing from. So all the fees that we'd already paid were for nothing. And we ended up with the same stock we already had. So communication lines, I think, are an important part of it.
Yeah, I think those examples that you mentioned, I think, are quite common, and a lot of people would know that. I had a similar situation where we were lending stock from a beneficial owner, and for some reason, if stock went hot and special, all of a sudden the client sold them. I'm like, okay, fine, he must be selling that. And after a few weeks, when things calmed down again, the stock was back in the portfolio. I'm like, let's start talking about this PM. Yeah, no, I've been selling this on swap to this prime broker. Great, thank you very much for your information.
Yeah, so look, that's we could probably go on with a series of stories there. So Jeroen, I guess really what we've talked about today, and we haven't really covered off everything else we want to do, is we talked about supply and we talked about flexibility. We've referred to it again. I don't know if you have any kind of closing thoughts for listeners on this second phase, this more in-depth view of what borrowers want from lenders. If you had to summarize, what are they looking for? What's most important? The 2 or 3 things.
Going back to what we discussed earlier, I think the flexibility is key. Being able to trade in and out of positions, being able to provide different kinds of collateral, being able to transact in term fashion, all those kind of things are important for a borrower, and the lender or the beneficial owner that can adapt the best or can have the multiple flexibility. That is always the preferred route. We talked about supply. Of course, nothing starts without supply. So we talked about the breadth and the depth of supply. Both are important. And how do you obtain, or how do you get that increased breadth or that increased depth? That can be achieved in multiple reasons. We talked about exclusives. We talked about synthetics. All those products are out there in order for the borrower to get as much inventory in the door as he needs. One of the things that we haven't really discussed about, which probably is again another podcast on itself, and that is costs. And as I said, generating money is fine, but if it goes out the door as quickly, on the other hand, on the other side, as it comes in, then all of a sudden the trade itself makes no sense. So reduce costs on RWA, on leverage, all those kind of operational costs, cost of collateral, all those kind of things. I think we need to have a separate talk about that, because of course that is also very important to borrowers. And I think as well, as I said earlier, if people have questions around this topic, please feel free to reach out, and we're always happy to talk about securities lending.
Yeah, thanks, Ed. I think that's a good summary. And as far as your sort of supplementary points there, I think that really sort of chimes and is consistent with the subject of the white paper, where we're saying, the old days, it was all about revenue. As long as I kept generating increasing revenue, it didn't matter so much that I was increasing costs. We're not in that world anymore. And so cost has become a much more critical issue. And in cost, I talk about all the elements of cost, really. One is the direct operational costs and trading costs. But as you point out, certainly the regulatory costs and the net impact on the bank's finite resources in terms of capital and leverage. And all of that goes into the cost. So when we look forward in future papers, we'll be examining what the ways or elements on key competitive issues where people can identify what those costs are and work towards reducing them and create a better operating environment for the future. And before then, even a competitive advantage until others catch up and match the leading edge firms. So Jeroen, thank you very much. Appreciate that. I'll be back for our listeners in a couple of minutes with a wrap up and thoughts on today's podcast. So thanks again, Jeroen.
Thanks, Roy, for having me.
Now I want to do a quick recap on what Jeroen and I talked about today. We talked really about 2 key things, flexibility and supply. So flexibility, ease of trading. The reality is a borrower needs to get the trade done. So for them, often that will be whatever the fastest route to execution is and the least error prone. So automation is the obvious answer there. It's not the only consideration, but it's easy to trade and execute electronically or automatically rather than calling around or sending a confirmation or a Bloomberg message or booking the trades manually. All of that is a problem. So path to least resistance of getting a trade, electronic execution. We also talked about collateral. We're always talking about collateral flexibility and how that leads to more business. We talked not only about the cost of collateral, but also the application of collateral and the best use of collateral by a borrower. So the widest range of acceptability for a lender will lead to the most opportunities for loans. And at times of crisis, like March and April, when supply of securities collateral disappeared, well, if you didn't take cash collateral, you probably saw an impact to your lending activity. We're not saying anything is good or bad. There's always trade-offs involved, but wider is better. We also touched on term transactions, how the certainty of a term for a trade is actually, or certainty of supply for that trade will be really critical in being able to execute it, how that adds value, and that value could be result in a premium for the lender. They're giving up flexibility, so they should be able to demand an increase in fee. We also talked about the regulatory reasons for term trades, so the HQLA, which everyone's familiar with. Clearly, that's going to be with us to stay. After flexibility, we moved on to supply, and we talked about depth and breadth and how really this is all about having a sort of a group of lenders. So whether that's domestic lenders combined with international lenders, because domestic lenders tend to have the biggest and deepest and most stable supply of their home market securities. Non-resident investors, though, often have global portfolios with global allocations. Passive investors really are, kind of in it for the long haul on those assets. So as long as people remain invested in their funds, they will hold some supply. So that's good stability there. But we also talked about the index tracking, and that's not a very commonly discussed point, but so many investors use the MSCI as their benchmark that many portfolios look broadly similar in as a result of that. So if you're tracking a non-MSCI index, the reality is if you're not lending, you should consider it because there will be people interested in your portfolio. If you are tracking another index, you're already likely seeing excess returns compared to some of your peers. We talked about exclusives a bit, but we are going to be doing the next episode focused exclusively on exclusives, if you will. So we talked about that. We'll dig into that more in depth next week. And then finally, we kind of closed out with synthetics. Look, it's a big part of the business. When you look at the transactions that are done through derivative contracts, and then you kind of include internalization, which is somewhat involved in synthetics as well, but in many ways you could argue it's broadly similar in that it takes demand away from the cash markets. Internalization, so long positions held internally aren't borrowed from agent lenders anymore. And in some cases, there's synthetics where there's long and short exposures wanted by a prime broker's customers, and they can offset those. But there's definitely a regulatory advantage for synthetics, so business will remain done and executed in that way. Where there's an option to do cash or synthetic, they'll typically take synthetic. Where you can't trade cash markets, obviously it's not detracting from cash securities lending. It's incremental. But any way you look at it, in my personal view, the size of the short exposure part of the market is as big today as it was under Lehman, and that wouldn't be obvious if you just looked at the cash securities lending market return. So for investors that can execute this way, that's a good way to generate incremental returns. Finally, Jeroen talked about reduced costs, whether that's actually direct operating costs or bank resources in terms of capital and balance sheet. We haven't talked about that, and no doubt that will be the subject of a future episode. Right, so that's it. As I said, next episode will be about exclusives. So I hope we can get your exclusive attention to talk about that next week, or at least listen to what we have to say about it. I'll be joined by both Jeroen again and John Arneson, another of my Pierpoint colleagues. Look, we want to provide you with the topics that you want to listen to. So if you have subjects that you think we should add to the show, just drop us a line. If there's guests that you think we should have on, send them through to us. Our contact details are always in the show notes. If you want to look at any of our content, because we do blogs, we do training, we do the podcast, obviously, and learning and education really is a big part of what we're talking about. So you can follow us at www.pierpoint.info. You can see us on LinkedIn and Facebook as Pierpoint Financial Consulting, and we're on Twitter as Pierpoint FC. And as always, we leave quite detailed show notes in the description. I'm Roy Zimmerhansl. I'm your host. Thanks very much. This has been Pierpoint Perspectives, the art of securities finance, and I look forward to catching you next time.